interest is piqued.
Yes, yes. Well, it's not a reference to poker, because I think sometimes when you go around the table, right, it's like, oh, are you going to raise or anything? No, this is some terminology in the investment community that when we go through earnings season, we're oftentimes looking at the results and then also what are they talking about the future, right? So in terms of the actual results from companies, we're coming out of earnings season. The results have been very good. We've seen actually 81% of companies in the S&P 500 beat the expectations coming in. Admittedly, the bar was being lowered throughout the quarter in the run-up to earnings season, where according to FactSet, the average expectation was for earnings to rise by about 4 to 5%. The actual result, closer to 11 to 12%. So that's the beat part. Now the raise, that's really music to our ears, because the beat is about what happened lately. We're interested in the future. And companies have been giving better what's called guidance.
So does guidance inform expectations?
They do, yes. And that's one of the things that managers of firms oftentimes recognize, is that if they give guidance, analysts are really going to listen to that and then adjust their expectations based on how credible is that guidance that's being given. Now, if you think back to the first quarter, massive amount of uncertainty. So from January, February, and March, then we had Liberation Day in April. During April, that's when the first quarter earnings season was going on. A lot of companies pulled guidance, meaning that they're like, we don't know what's going to happen, so we're not even going to pretend to know, so maybe we'll lay out some different scenarios and you can choose your own adventure. Now they've actually gone back to giving that guidance, and oftentimes that guidance has been a lot better. Just some examples from this past week. A number of retailers, think about like your Kohl's, your Williams-Sonoma, Dollar General, right? Each one caters to a different type of customer.
You kind of covered it there, right?
It
right?
really does, yeah. And they all basically said, okay, we know that tariffs, if they go into effect and stay where they are, we can kind of figure out what the cost is going to be to us. And they're feeling like the foot traffic is getting a little bit better. So they're able to raise their guidance. Now, in some cases, like for Kohl's, for example, more than 3 years in a row, they've seen declining sales. But in the month of July, the CEO said that we're actually seeing flatline. So it's no longer going down. So maybe the first step to getting rising sales is to first see them stop dropping.
And then with everything in general, used to be the tent pole.
The Magnificent Seven.
Magnificent
yes.
Seven.
Yeah.
So that was the tent pole that helped the market in general,
it
right?
really did.
How'd they do? Where did they come through?
Okay, so the Magnificent Seven, and I'm really glad that you bring that up because it's a term that we haven't heard a lot about lately, mainly because they've seemed to be going their own way. It's almost become this ragtag group of companies. It used to be that, hey, these are mostly technology companies and they all rise and fall together, but they've been really going their own ways. Like Tesla, their stock price performance very different than, say, Microsoft. Microsoft very different than Apple. Apple very different than NVIDIA. This past week, NVIDIA reported. So they are the largest company in the United States and actually in the world, according to the market capitalization. So more than $4 trillion. They reported their earnings, and in terms of the revenue that they were getting, I mean, just get these numbers. About $55 billion for the quarter. So you multiply that by 4, that's the amount of revenue that they expect that they're going to be getting this whole year. Now, they sold $0 into China. And that was really interesting to say, hey, we're assuming we sell nothing into China. If we could, that could be like a $5 billion opportunity for them. I mean, these are huge numbers. Interestingly, it missed expectations. So even though you would think that a number like that's like, oh, that's got to just trounce the expectations, but that's the importance of the guidance, analysts' expectations, and then the results. So the guidance, sometimes management, they want to set lower expectations. Analysts, they go in and they try to tweak those up or down. And then when the rubber hits the road, when they actually announce the earnings, that's what can really move the stock prices.
So if companies are offering more optimistic guidance, does that mean that they are optimistic? What do they know that we might not know?
Yeah, they're less pessimistic. Maybe it's not so much that they're more optimistic as less pessimistic. The CEO surveys, like the Conference Board, they have one that they put out every quarter, and the CEO confidence was at a very low point, really depressingly low back in the first quarter, and it's begun to rebound. A lot of that is because of something that we've been talking about quite a bit. As we go through this year, we are likely to see more clarity. Like the policies or not, at least you have clarity as to tax policy. That got passed July 4th. Tariff policy, we know that most of those are mostly resolved, not completely, of course, but at least mostly. And now monetary policy is becoming much more clear as well. And so given that clarity, CEOs seem to have more confidence, and that's beginning to show up in the economic data too. This past week, we got the revisions for the second quarter gross domestic product. Now, this is a little old news, because that was all the way back in June as far as the quarter that was ended there. But we actually saw a big jump in business spending. And if you think about the One Big Beautiful Bill, that's really what it incentivizes, is spending on property, plant, and equipment. And those were some really key drivers of growth in the second quarter before the bill was passed. And so we expect that we're probably going to see that investment spending snowball and accelerate as we go through this year to help support growth.
In our final minute in this Week in Review, let's talk a little bit about inflation. We don't see a fresh CPI number until the 11th.
That's right.
So I saw in your notes, inflation is more than just tariffs. Is it really?
It really is. Everybody's focused on tariffs, and understandably so. We're definitely concerned, but I want to put it into perspective. If you think about the typical American consumption basket, and we got that data this past week for the month of July, spending on goods as opposed to services. So spending on goods, it's about 30 to 35% of what your typical American spends. Those goods, about 10% of that is imported, either directly imported or like some component or input part of it is from outside of the United States. So tariffs are important, but they aren't going to be the long-term driver of inflation.